CDs sound simple, but the fine print decides whether they help or hurt. Most CD confusion comes from treating a CD like a savings account, and it's not. You usually can't withdraw anytime, and you typically can't keep adding money after opening. The rate is often fixed, but fixed doesn't mean you can ignore the rules until the end. Guaranteed also doesn't mean unlimited insurance. Coverage has caps. And the maturity date matters because what happens then changes your access, your rate, and your next steps. A certificate of deposit is a trade. You lock money for a set term, and the bank pays a stated APY agreed up front. You pick the principal, like $500 or $10,000, and the CD grows until the maturity date, which is the payout point. If you need the money early, you can often get it, but a penalty applies. Your deposit can be protected by FDIC or NCUA insurance, but only up to the coverage limits per depositor per institution. The APY is the real earning number because it includes compounding, meaning interest earns interest over time. That's why $10,000 at 0.01% earns about $1 a year, while $10,000 at 4% earns about $400 a year. But the catch is the early withdrawal penalty, often listed as X months of interest. If you break the CD early, that penalty can wipe out your interest, and in some cases it can even reduce your principal. Use CDs best when you match the term to a real goal date, because liquidity is the trade-off you're accepting. If you might need the money, don't lock all of it up. Consider a CD ladder, like splitting $12,000 to four 3,000 are CDs that mature at different times. Also learn the maturity window, often about 7 to 10 days, when you can change or withdraw without penalties. Watch for auto-renew and confirm your insurance coverage and it stays within limits. Before you open a CD, focus on the rules that change your outcome, not just the APY. Confirm the early withdrawal penalty in plain months and verify when interest credits, monthly, quarterly, or at maturity, because timing affects access. Check the minimum deposit requirement so you're not surprised at funding. Ask whether partial withdrawals are allowed. Many CDs require closing the whole CD. Set a maturity reminder and keep total balances within FDIC or NCUA insurance limits. An early withdrawal penalty is often months of interest, and it can even hit principal. BankingHub matches you to accounts based on how you actually bank and shows the real dollar impact for your balance. Free, takes 2 minutes, and the link is in the description.